Guys, it has been a big, jam-packed week for earnings. We've done a lot of videos, but there's a few of them that we didn't cover. I'm going to run right through them right here. We have about 8 of them. So the first one, GM. They raised guidance. Their stock went bonkers. I can't believe that GM went up over like 2 or 3%, but they raised guidance. I pulled up Stock Analyzer tool here, and this is what I'm going to do. I'm going to kind of give you a little tidbit about it, and we're going to run through Stock Analyzer and see what we should pay. Now, this is a car company. It's very hard for me to look at a car company and say, what do I want to pay for this thing? Because margins are so bad. It's such a volatile industry. If you look back at a video that we previously posted, I talked about companies that are recession-proof, and we looked at a couple car companies. They struggle. So look at this real quick. I went through and I did 0% revenue growth on the low end. This is saying that we go into a recession and they don't, remember, this is 10-year analysis, and the next couple of years are tough. 2% revenue growth in the middle, 4% on the high end. Profit margins, I kind of ran the gamut here. 3.5%, let's say margins stay low. 5.5% middle, 6.5% is absolutely crushing. I really don't see this type of situation. Same thing for free cash flow margin. PE, 12, 14, 16, same for price to free cash flow. And as far as my return goes, I think this is achievable to do no revenue growth. I think they're going to do better than that. I'll give them a 10% annualized return. Margin of safety, I need a little bit more for 2% and for 4% over the next decade, which I think we're going to have some type of recession in it. I need a 14% return in there. Let's see what we would pay for this thing right now. Now here's the thing. This one lights up all green. This doesn't mean go and buy it. This means go look back at history. See what they did in the last recession of 2008 and stuff. Also, see what their plans are going forward. Them raising guidance, talk is cheap. Talk is very cheap. Saying that you're going to do more profit, you're going to do more revenue, things are great, coming out of supply chain, that's all one thing. Actually doing it is a whole different story. Next one, McDonald's. McDonald's raised same-store sales 12+%, I believe. It was absolutely out of this world. They increased their traffic all over the world, and they're talking about they're improving their quality. They're kind of adapting their menu a little bit. So quickly looking at McDonald's here. Almost $300 a share right now. And look at this. Amazing return on invested capital. Amazing return on invested capital. Great moat. Revenue growth. 3, 5, and 7. Profit margin. 21, I think that's very low. 23, achievable. 25, I think it's achievable, just looking at these numbers right here. And I know we've had, margins have decreased a little bit this year. Free cash flow margin, I did the exact same numbers because they're relatively close. PE, 15, 17, and 19. And I gave them such a high PE on that end because it's such a great moat. It has such a great ROIC. And for my margin of safety or my return, 10%, 12%, and 14%. So let's see what we would pay for McDonald's. I have a feeling this one's not going to be pretty. Yeah. You can see it's on my watch list at $80, $98 on the low end, $136 on the high end, $116 in the middle. This is a tough one for me. I am going to raise this, though. I think that I would be willing to pay more than the low end for a company as good as McDonald's. Next one is Chipotle. So Jim Cramer just tweeted out recently today that you need to go and buy Chipotle, and Chipotle is worth being over $2,000 a share. So everybody, go and short Chipotle. I'm just kidding. They increased margins by 25% over the last year. That's amazing. This is a business with, I believe, 58 ingredients, and they just do so well. They make a great product. But the company, the stock price is out of control. Pretty decent return on invested capital. So revenue growth going forward for the next decade. 7, 10, and 13. I think 13 is a little bit high. I think 7's pretty low. 10% is probably a reasonable number. Profit margin, 5, I really beat it down, 7 and 9%. Now they are, you can see, they increased margins 25% over the year. They're adding a couple more things to their menu. I think they have these like TikTok hacks now where you can go and make like a Philly cheesesteak or something like that. Avocado prices are coming down, so they are able to increase margins in this way. Free cash flow margin, I did the exact same thing. PE, again, I don't want to say moat, but they're a brand that everybody goes to and you can get consistency as you go around the country. 15, 17, 19, 15, 17, 19 for price to free cash flow. And I put in my standard 10, 12, and 14% return based on those numbers. Let's see. Oh boy. It's on my watch list at $700, currently at $2,000, between $300 and $750. Let me look at their PE real quick. Their PE is sitting at, yes, 5-year PE of 91, current PE of 50. These numbers make sense to me. These numbers do make sense to me. Would I be willing to pay a premium for them? I don't know. We'll see. Let's go to the next one. Pepsi, hitting a 52-week high, raising their forward guidance, raising their outlook, $188.50 a share. Let's see what we would do with Pepsi. Now, Coca-Cola did very well. Revenue growth, 2, 4, and 6. And you guys might look at the 1 year and say, oh, they grew so much. No. You need to look at 5 years, look at 10 years, look what they've done historically. Don't just focus on 1 year. Profit margin of 7, 9, and 11. All of them seem completely realistic to me. Free cash flow margin, same thing. PE, 14, 16, 18. Same for price to free cash flow. And my return, again, 10, 12, and 14%. Let's see what we got going on here. Okay, so 60 on the low end, 110 on the high end, 85 in the middle. Let me check this PE real quick because these numbers are pretty wild. And yeah, you're sitting at a 34 PE. It does make sense. These numbers do make sense. Now, guys, these are companies that we didn't cover. If you want to look and see the videos that we did on Coca-Cola, Meta, Microsoft, Google, Visa, Intel, Amazon, click right here, go and watch those. They're all done, and we go into a little bit more detail on them, pull out the press releases and go through them. But let's go to the next one, 3M. 3M, and by the way, subscribe to the channel because we're going to be doing a lot more of these next week, including Apple. 3M is something that a lot of people in the Everything Money community like. For me, it's a business that kind of does everything. They're involved in everything. I bet you something in the room you're sitting in right now is 3M. Revenue growth. They do have great return on invested capital over the last decade and the last 5 years. Revenue growth, 2, 3, and 4. Profit margin, 15, 16, and 17. And why did I make it so consistent? Because they have been consistent over the last decade. I almost put 16 in across the board. Free cash flow margin, I put the same thing in. PE, 14, 16, and 18. And I could make the case that I could go lower with those numbers just because this is more of the dinosaur type company. They're not really going to have anything to grow. Same thing for price to free cash flow. And because I do believe this revenue growth could be hard to achieve, I put in a 14% desired annual return down there. That's my little margin of safety. Now let's click Analyze. This one is all green. And this is one where before you go and just buy this thing because it looks really good to you, 123 to 133, middle ground of 129. Before you go and just start buying this, figure out why it's down here. Why is it not moving? Because this has been lighting up green for me on my stock analyzer tool for quite some time. Make sure you go pay attention to that and make sure you have a good reason for buying it and a good projection in stock analyzer for what this company is going to do over the next decade. Another one, Spotify. They missed, but their monthly average usership grew 22%. They're at 515 million monthly active users now. The problem is they don't make a profit, barely make cash flow. And that's the hard thing for me. So looking at this is the hardest type of stock analyzer for me to do. Revenue growth. I mean, they don't have return on invested capital. Revenue growth, 10, 13, and 16. I'm projecting out a decade. All of them I can see feasible. Now, profit margin, this is hard. I'm guessing here. 7, 13, and 19. I might be able to go in here and put in 15, 25, and 35. I don't know. But this is assuming that they're profitable today. Not in the future, today, starting right now. And that's not the case. Free cash flow margin, I did the same thing because those should equal out over a long period of time. PE, 16, 18, and 20. Notice I gave them a 20 PE because they can generate that growth. You could argue that this could be a 23 PE. I don't know. And then as far as the return, I have to get a little bit more margin of safety because there's so much unknown. 12, 14, and 16. And depending on the numbers that you put in here, you need to make that a little bit higher. I could even justify saying 16, 18, and 20 because this is purely speculation. Actually, you know what? I'm going to do that. 16, 18, and 20 because this is not a company that I would be buying right off the rip. I'm afraid to see these numbers. Okay, there you go. This is exactly what we're saying. 78 on the low end, 283 on the high end, 168 in the middle. So you're looking at this saying, Mo, those numbers are green. Yeah, those numbers are green, assuming that you're getting these types of profit margins and free cash flow margins right now, starting right now. It's not happening. So that's the cautionary tale that you need to follow. So that's Spotify. All right, the next one we're going to hit is eBay, and you can see they were up 5% today. Why? Because they increased their dividend. I'm assuming that's why people flock to that thing today. So let's go through eBay. eBay is a very interesting business to me. I use it. I buy from them. I sell from them. I actually sold a putter yesterday, and I bought a golf, TrackMan-like thing the other day. So I still use it. People still use it. It's a great place to shop, but let's see how they do in the future. Pretty good ROIC, halfway decent ROIC of 10 years. All right, revenue growth. I put in 0 because I don't know. 2 and 4. I think the 2 is probably the most reasonable. 0 is incredibly low. 4 could be a little bit high. Profit margin, 30, 35, and 40, just because they've kind of been all over the bat. This needs free cash flow margin, 20, 25, and 30. It's definitely been lower. PE, 14, 15, 16. Same for price to free cash flow. I don't think this is a very big growth business. And my return, 10, 12, and 14. And I could argue that low end, I could actually go less because I don't foresee them doing 0% revenue growth over the next decade because people still buy and sell stuff there. It's a safe place to go. All right, especially because they're starting to do a lot of verification of Rolexes and Louis Vuittons and higher end stuff. It's on my watch list for $35. 41 to 62 on the low end, 68 to 91 on the high end, 55 to 75 in the middle. It's on my watch list for $35. And the reason is it's a company that I want to get really cheap because I'm not sure. I've done my analysis on them. I really cannot make a judgment call on them. So if I want to buy them, to me, it has to be quote unquote dirt cheap. All right, let's go to UPS. So UPS is not FedEx, therefore I like them. So, mixed earnings, 6% dip in revenue year over year. Operating profit fell 22% year over year. Shipping business is tough, especially after after COVID. Margins are pulling back. Everything's starting to pull back now. International shipping is the thing that's kind of carrying the shipping businesses. But let's see here. So, from a revenue growth side, and I must say, their return on invested capital is awesome. From a revenue side, 2, 4, and 6. Over the last decade, they've done 6.8. That included a crazy year of COVID where that margin really jumped. So 6% I think is realistic because this is a little bit inflated. All these numbers, well, these two numbers are inflated. Profit margin, 5, 7, and 9. I think that 5 is probably a little low. 9 could be a little high over a decade. 7's probably my number, my sweet spot number. Free cash flow margin, I did the same thing. Now for PE and price to free cash flow, 14, 15, and 16. I don't really see a lot of growth coming out of here. I don't think that they can do anything that's going to really boost them. Just keep doing what you're doing and do it in a more efficient way. 10, 12, and 14% return. Let's see what we get out here. Let's click Analyze. $172 is the current price. And this is another one. 76 on the low end, 150 on the high end, 112 in the middle. You can see it's on my watch list for 55. Maybe it's a little bit low, but it's another one of those that because of the industry that it's in, I just want to get that thing for dirt cheap. Now, a couple of companies that just reported for us. Roku, disruptive. $1.38 versus $1.37. That's a beat. $741 billion versus $708 billion. That's a beat. Let's see here. Okay, so the stock is up 2.37% right now. Let's go to Stock Analyzer. Oh, this is going to be a tough one. This is the same thing as Spotify. Why? They don't have profit, and they don't have free cash flow. So this is going to be a speculative move for me to put in here. Now, revenue growth. Oh boy. Okay. Let's do 10, 15, and 20. This is over the next decade. Okay. Profit margin. Oh boy. Oh my God. Let's do 8. No, let's just do 10, 15, and 20. I mean, this should be a high margin business. I don't think they produce any of their own shows, so it should be a high margin business. 15, I guess they have devices they need to sell, Roku TVs, etc. 16, 18, and 20. 16, 18, and 20. Shout out to Cathie Wood on this one. 16, 18, and 20. And you're probably saying, why is your desired annual return so high? Because these are very speculative numbers. Here, again, let's go through this. So we're looking at this saying 37 on the low end, 38 on the low end, 130 on the high end, 76 in the middle. But I'm giving them a profit margin on these two of 15 and 20. on these two numbers right here. That's assuming that we start profiting today. That's not happening. So you need to be very cautious with this. I don't even know how close to profitability they are. I mean, their profit margin last year was minus 16%. So I would say that they're not too close. I know they're making a lot of push into putting their Rokus in televisions, which is a great product, but a great product doesn't necessarily translate to a great business. So that's Roku. Teladoc, another shout out to Cathie Wood. Oh, it's up 5%. That's awesome. They, earnings per share, lost 42 cents versus an expectation of losing 51 cents. Congrats. 629 million in revenue versus 618 in revenue. Cool. Beat on top and bottom line. I don't understand this company. I don't get it. It just literally melts my brain all the time. But this is going to be another speculative play because they lose money like nobody's business. Last year, their profit margin was negative 567%. They barely have free cash flow margin. They have a price to free cash flow of 252 right now. Okay, let's try this. Revenue growth. Let's do 15, 25, and 35. I'll just roll with it. Whatever you like. Profit margin 10, 20, and 30. 10, 20, and 30. PE, I'm going to go 18, 22, and 24. 18, 22, and 24. And I'll go 16, 18, and 20. Now, I will say I would not be buying this company. I'm just going to put that out there right now. So look at this. It's a buy all day if you believe the assumptions I put in. If you think they're going to have revenue growth of 15, 25, and 35, which I actually think is the only realistic thing on this chart, they're going to start having profit margin today of 10%, 20%, and 30%. Same for free cash flow margin today, which they're not. PEs 18, 22, 24, and you can yield these types of returns, then yeah, you buy this all day. But for me, this is one of the most speculative plays out there. I think this company is just, I just don't get the point of it, frankly. But that's it. So guys, that was a lot of stuff I threw at you. Subscribe to the channel, join the community. You will love it. Hope you enjoyed this one, and I will see you later.